Here's an interesting question now. What are the factors that affect the exchange rate of a currency? So first one, foreign trade, supply and demand. If payments into the Eurozone are greater than payments outside of the Eurozone, there will be more demand for euro. As a result, the euro would appreciate or increase in value. Interest rates. If a country is offering high interest rates, money should flow into that country to avail of the high returns. However, to do so, the individual or the firm seeking that return must first buy that country's currency. So therefore, there would be an increase in the demand for that currency, the value would go up. The level of money supply. If there's an expansion in the money supply, the value of the currency falls as supply exceeds demand. As imports become cheaper, there will be an increase in the demand for foreign currency and a possible fall in the value of that currency. Now, as a point to note, between 2015 and 2018, the European Central Bank increased the money supply, and it did have an impact on the value of the euro. And speculation or speculators. If a significant number of people participate in the currency market, they can influence the exchange rate through demand and supply. Next interesting concept here is called the purchasing power parity. This is very interesting now. The purchasing power parity theory states that in a free market, the exchange rate between one currency and another currency is in equilibrium when their domestic purchasing powers at that rate of exchange are equivalent. For example, in Ireland, a bottle of water costs €1. The euro to dollar exchange rate is 1.26. I've just made that up. If the bottle of water holds to the law of purchasing power theory, then the price of the bottle of water in the US should be $1.26. Now, issues with this theory. Exchange rates are determined by several factors, as we saw in the previous note. Transport costs are ignored. Many goods and services are not transportable, right? And free trade is not always available in all markets. Now we're going to look at some terms that could come up in short questions. So we're looking at protectionism. This refers to efforts by a government to restrict free trade, particularly imports. Free trade means that there are no barriers to the movement of goods and services between countries. A trading bloc. This is a group of countries sharing free trade with each other. For example, the European Union and NAFTA, the North American Free Trade Agreement. Fair trade is a partnership based on dialogue, transparency and respect that seeks greater equity in international trade. Dumping, where goods from one currency are sold abroad at a lower price than the price charged for them at home. I would also put in there that there is kind of a widespread selling of those goods in a foreign country. Fixed exchange rate. The value of currencies are agreed upon, and each participating country undertakes to exchange the currency at that value. So, for example, the Irish euro is fixed against the German euro. And lastly, then, a floating exchange rate. The value of the currencies fluctuate in value, and this depends on supply and demand for those currencies.